Happy Friday out there, Team 42. It's your skipper here, Darius to present our macro minute for Friday, January 17th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, what is the current health of the U.S. and global economy? Our answers are a barrage of critical economic releases from the US and global economies affords us the opportunity to take a much needed mental break from trying to assess the size, sequence, and scope of the pending fiscal, regulatory, trade, and net financing policy changes in the US and how they may interact with the economy and asset markets in a near record year for global debt refinancing demand. While we will be tasked with reassessing those upside and downside scenarios all year, so it is important that we maintain a high quality baseline of what is actually happening on the ground. Regarding the U.S. economy, the latest data from the U.S. manufacturing sector were highly supportive of our resilient U.S. economy theme. Regarding the Eurozone economy, the final December CPI data were supportive of our grid model forecast for inflation to trend higher over the medium term. Regarding the UK economy, the December retail sales data were supportive of our grid model forecast for growth to bounce and stabilize in Q4. Regarding the Chinese economy, the Q4 GDP data and December activity and property market data were supportive of our grid model forecast for a transitory bounce in growth in Q4. While Beijing is stimulating more forcefully than it has in recent years, it is far from stimulating forcefully in absolute terms. Indeed, after months of disappointing stimulus headlines, we do not view China's current policy mix as supportive of a sustained recovery in the Chinese economy. Investors should anticipate a deepening of China's balance sheet recession throughout 2025, albeit at a slower pace than in prior years. Treading water would likely feel like a win for Beijing in a year where incremental U.S. tariffs are likely to force a meaningfully and potentially destabilizing depreciation of the Chinese yuan. Transitioning to our 42 macro dashboard, as always, we'll wrap up with the question from our community. This one's regarding liquidity, specifically the TGA spin down, our TGA spin down thesis. Says, hello, Skipper. I realize that liquidity isn't just as simple as the TGA spin down. It's more of a function of several factors, including what is happening with the RRP, reserves in the system, and I'm sure I'm missing a component or two here. That is correct. However, given all you know about liquidity, even with the TGA spin down about to begin, will it actually work out to being a liquidity positive event? Let's start by saying, excellent question, well contextualized. There are other factors that matter in terms of specifically, thinking about global liquidity as well. This is really specifically as it relates to U.S. liquidity and our net liquidity model, which is everyone's net liquidity model, by the way, which is Fed balance sheet total assets minus the TGA and RRP. That's become the most popular model on global Wall Street to track U.S. Liquidity dynamics, thanks to our friends over at Morgan Stanley. But anyway, that's neither here nor there. What is here is I think the gist of the question is, how likely is it that the TJ spin down, of which there's roughly, last I checked yesterday, was $672 billion in the TGA. If we see a, somewhat lengthy debt ceiling impasse, lasting on the order of several months, we could potentially see that, trend towards zero or at least the low $100 billion range. We're going to have, 3 to 4 to 5, 6, maybe even $600 billion spent down on the TGA, which would be a liquidity positive event. However, you could potentially see an offset of that if investors are concerned enough about duration risk to crowd money back into short duration instruments. And if there's not enough bill financing, which of course there isn't in a debt ceiling impasse, then you could potentially be seeing the RRP balance rise to some degree to offset that. Now, again, how much it rises to offset that, the ratio of RRP potentially rising, if it does rise relative to TJ spin down, is not something that's forecastable. More importantly, these things aren't forecastable to begin with, right? I mean, you could forecast, we're making qualitative assessments of the likely outcome, but these aren't, specific hard data-driven forecasts. If you look at all the we run a multivariable analysis to try to identify what the leading indicators and lagging indicators are for liquidity. And on the leading indicator front, you think about something like the RRP balance of the TGA balance, the correlations across most things in financial markets, whether it be things that are really important for liquidity, like real interest rates, term premia, the US dollar, interest rates differentials, all those kinds of things, they tend to have, very sparse correlations, with things like the TJ and RRP. Right now, if you think about what's the highest, the variable that has the highest amount of signal for determining the RRP direction right now are the 10-year tips break evens currently, and the correlation is only 0.17, positive 0.17. So again, this is more statistical noise than anything. And so trying to, come up with a quote unquote forecast for these variables is a fool's errand. I mean, I built models for a living, and we have some very important institutional clients around the global Wall Street that pay attention to those models. And so I think I know what I'm doing here when it comes to forecasting. And my reality is, if anyone tells you that they can specifically forecast the TGA with precision or the RRP balance with precision, they're fools. I mean, that just is what it is. And I have no problem saying that and telling that to their face. Don't forget, I'm a former highly decorated offensive lineman. So we'll wrap it up there. I think the key takeaway here is we expect TGA spin down to be a liquidity positive event. It could potentially offset if we continue to see duration risk spook investors into short duration instruments on the Treasury curve. That is not something I expect to that's not the outcome I expect, at least in the first few months of the year. But that is not certainly, but I think that's a high probability scenario where we might see as we progress deeper into the year. Recall that we have inflation accelerating appreciably in late Q2 and early Q3. And so that's where we would expect to see the maximum amount of duration risk, especially in the context of what is likely to be the near record peak demand and global refinancing deed, kind of in Q3 of this year. So talked about a lot. Obviously, it's all data driven. If you want to review the analysis supporting these conclusions, as always, you need to be a client of 42 Macro. So we'll wrap it up there. Everyone have a wonderful 3-day weekend. We got Martin Luther King Day, in my opinion, the best holiday. I wouldn't be here without that holiday. So I'm super pumped for that on Monday. Obviously, got the presidential inauguration as well. So we'll catch you back here on Tuesday. Everyone have a wonderful weekend, and catch you back on Tuesday. Cheers.